Hello everyone, welcome to the March edition of BCAS Tax Gurucool. I am Vihit Vasani, Chartered Accountant, and I would like to thank BCAS to have given me this opportunity to share my thoughts with you all in this BCAS Tax Gurucool series. It has been a quite bumpy ride since beginning of 2020 due to coronavirus outbreak, and in whatsoever aspect of life, nobody was spared since then. Today, however, I am going to talk about one of the incentivizing as well as encouraging mechanism to save tax for new domestic manufacturing companies. Yes, today I am going to share my thoughts with respect to Section 115 BAB of the Income Tax Act, which falls under Chapter 12, that is determination of tax in certain special cases. Section 115 BAB was introduced by Taxation Laws Amendment Ordinance 2019. This ordinance was announced at a press conference held by Honorary Finance Minister at Goa. Apart from these provisions, various other beneficiary provisions were also announced at this conference. They were concessional rate for corporate assesses, reduction in MAT rate, relief for companies that had announced buyback prior to budget, rollback of enhanced surcharge, etc. The main motive and intention behind this ordinance and this provision was to boost Make in India, attract investment in manufacturing entities, have a competitive global tax regime, and of course, ease of doing business. This ordinance was enacted by assent of President on 12 December 2019. Now let us look at the gamut of this section. This section is applicable from assessment year 2020-21, that is relevant to financial year 2019-2020. It is applicable to a domestic company which is either engaged in manufacturing or producing activities. That means it will not be applicable to a partnership firm, LLP, or a proprietary concern. The company which is opting for this regime will be liable to tax at mere 15% for its profit from manufacturing or producing activity. However, if the company earns up income or a gain from activities which are either not incidental or directly in connection to this manufacturing or producing activity, will be liable to tax at 22%. If the department is of the opinion that the company has manipulated its profit, then it may decide to levy 30% tax. This tax rate is to be increased by further surcharge of 10% and education cess of 4%. There are certain prerequisites in order to be eligible for this provision. Number 1. The company should be set up and registered after 1st day of October 2019, and the said company should commence its production prior to 31st March 2023. However, the date of commencement of production has been recommended to be extended to 31st March 2024. Number 2. The company should not be formed by either splitting or reconstruction of its already existing business. Number 3. The company for its production or manufacturing activity should not use any of the machinery or plants which are already used in India. Number 4. The company should not use any building which was previously used as a hotel or a convention center for which deduction under Section 80 ID was claimed earlier. Number 5. The company should not be engaged into any other activity apart from manufacturing or producing activity, or any other activity which are incidental to it. There are certain classes of business which have been specifically excluded from applicability of these provisions, like software development, mining, conversion of marble block into slabs, bottling of gas into cylinder, printing of books, or production of cinematographic films, or any other business as may be notified. However, manufacturing of electricity has been specifically included for applicability of these provisions. Number 6. There are certain deductions which will not be applicable to the company once it opts for Section 115 BAB. They are deduction under Section 10 AA 32 AD, additional depreciation under Section 32, 33 AB, 33 ABA, certain subsections of 35, 35 AD, 35 CCC, 35 CCD, and also the deduction under Chapter 6A will not be applicable apart from Section 80M and 80JJAA, that is in respect of deduction of certain intercorporate dividends and deduction for employment of new employees respectively. Once the company opts for Section 115 BAB, it will not be allowed to either set off or carry forward of loss because of unabsorbed depreciation on account of this aforesaid deductions. To avail the benefits of this section, the company has to exercise option by filing Form 10 ID once on or before the due date for furnishing the first return of income. Once the option has been exercised by the company in any previous year, it cannot be subsequently withdrawn for the same year or any of the previous years. The form is a simple form wherein the company has to certify that all the conditions as laid down in Section 115 BAB has been duly fulfilled. Further, the company has to also declare that it has opted for Section 115 BAB while filing the return of income. To conclude, effective 8% reduced tax rate is a real boost for the new manufacturing companies to start with. It will definitely help in attracting new investment as well as assist the companies in its future growth. It is a competitive rate as well considering the global counterparts like UK, US and Singapore. Secondly, if opted for this section, the provisions of Section 115 JB, that is MAT, will not be applicable. The only thing which needs to be kept in mind that the deduction under 80 IAC, that is deduction for profits for eligible startup, will not be applicable once the company opts for Section 115 BAB. With this, I would like to thank you for the patient hearing. We welcome your feedback and suggestions. You can send us the same at bcastaxation@gmail.com. The material for this session is available in the description box. Have a good day and happy learning.